G'day legends, welcome back to the Gold Jumper channel, where we track the shiny stuff and the global chaos affecting your portfolio. Jump up and under, let's get into it. Today we are breaking down the massive energy shock from the war in the Middle East and how it is rattling the gold market. We are looking at the Reserve Bank of Australia's shock interest rate hike and why the Aussie dollar is doing the tango. Plus, we will dive into why the tech giants are cracking and what the charts say about gold hitting a 4-week low. Just a quick reminder that I am not a financial advisor, so please do your own research before putting your hard-earned cash on the line. The big question for today is simple. Is this gold dip a trap for the bears or a golden entry for us legends? Are we looking at a temporary flush or a structural shift that could send gold to $6,000 by Christmas? If you love the daily hustle, make sure to smash that like button and subscribe to join our growing community of traders. Drop a comment below with your prediction for gold prices by the end of March 2026. I reckon it's going to be a wild one. We have some serious breaking news coming out of the Persian Gulf as of Thursday, March 19th, 2026. Operation Epic Fury has entered a brutal new phase with the United States and Israel intensifying strikes on Iranian missile sites. The Pentagon confirms they have carried out over 7,800 strikes since this whole conflict kicked off in late February. President Trump is currently weighing up whether to send thousands more troops into the region to finish the job once and for all. This kinetic conflict has turned the Strait of Hormuz into a complete no-go zone for any shipping allied with the West. Crikey, it's the largest oil supply disruption we have ever seen in history, with 8 million barrels a day missing from the market. The Iranian Navy is reportedly in tatters, but they are still using drones and missiles to harass tankers trying to sneak through. Even with the US Navy trying to provide escorts, most commercial ships are dropping anchor and waiting for the dust to settle. This geopolitical nightmare is the main reason why every commodity on your screen is moving like a startled kangaroo right now. Don't sweat the dip, just more room in the pouch, because these headlines are exactly what keeps the long-term bull market alive. Let's talk about the black gold, because WTI crude oil is acting absolutely mental as of Wednesday, March 18th. While the headlines say oil is around $96, the real stress is hidden in the refined products like diesel. The Oil Volatility Index, or the OVX, hit a massive reading of 121 earlier this week. That is the highest level of fear in the oil market since the dark days of the pandemic back in 2020. We are seeing a massive premium for immediate supply, which the smart cookies call pronounced backwardation in the futures market. If you are filling up the ute this week, you have probably noticed US diesel has already surged past $5 a gallon. The International Energy Agency is calling this one of the worst energy shocks ever, and they are releasing 400 million barrels. But let's be fair, dinkum, even a record release like that is struggling to fill the hole left by the Hormuz closure. High oil prices are stoking inflation fears, which is why the US dollar is staying so strong and keeping gold under pressure. Traders, keep a close eye on the current breakout above $97 for WTI to see if gold rallies behind a new surge in oil. Closer to home, the Reserve Bank of Australia gave us a proper shock on Tuesday, March 17th, 2026. In a razor-thin 5-4 vote, the RBA board decided to hike the official cash rate by 25 basis points. That puts our interest rates at 4.10%, which is the highest we have seen in quite a while. The market was only 80% sure they would hike, so that extra bit of hawkishness sent some ripples through the ASX. It seems our central bank is worried that rising energy costs will make our local inflation stickier than a jar of honey. The dissent on the board shows that they are worried about crushing the economy, but inflation is still the big bad wolf. This was a back-to-back hike, something we haven't seen since the aggressive cycle started a few years ago. For you legends holding mortgages, this is another squeeze, but for the Aussie dollar, it provided a bit of a flaw. The RBA is the first major central bank to hike since the Iran war started, showing they aren't afraid to be the outliers. Watch out for the next batch of employment data, because that will determine if they go again or finally take a breather. Looking at the ASX 200 index, it has been a total tug of war over the last 48 hours of trading. On Wednesday, March 18th, the index managed to gain about 0.31% to close at 8,640. Our heavy hitter banks like Westpac and NAB actually climbed because higher rates mean fatter profit margins for them. But the interest rate sensitive tech stocks on the ASX took a proper bruising after the RBA announcement. Zip dropped nearly 6% and Block slid over 2% as investors scrambled out of high-growth names. The materials sector found a bit of a bounce, with BHP and Rio Tinto up about 1% as iron ore prices stabilized. Gold miners like Northern Star and Evolution Mining are having a tough run, with Northern Star down nearly 20% this week. It is a bit of a paradox, mate, seeing gold miners bleed while the world is basically on fire in the Middle East. On the Forex side, the Aussie Dollar pair tested above 0.7090 on Tuesday, before easing back slightly. Our dollar is stuck between a hawkish RBA and a super strong US dollar that refuses to give up the top spot. Now, let's check in on the magnificent 7 tech giants over in the States, because the dominant narrative is cracking. For the first time in ages, names like Apple and Microsoft are actually doing worse than the average stock in the market. Nvidia is still the king of AI, but even they are feeling the heat as competition starts to nip at their heels. Tesla is the one to avoid right now, Legends, with its valuation at nearly 200 times its estimated profits. Most of the Mag 7 were down year-to-date as of March 17th, which is a massive shift from the last 2 years. We are seeing a move toward the so-called TACO trade, which stands for Trump always chickens out on his tariff threats. But some traders are calling it the TATA trade now, meaning Trump always tries again, especially with these new sanctions. Amazon and Microsoft are down over 7 and 15% respectively so far in 2026, which is quite a haircut. Investors are getting worried that the massive spending on AI won't pay off as quickly as everyone first thought it would. This rotation out of tech could eventually be a huge win for gold once investors look for a place to hide their capital. There is some massive news on the de-dollarization front that you won't hear much about on the mainstream news channels. Reports are flying around that Iran is allowing oil tankers through the Strait of Hormuz if they pay in Chinese yuan. Pakistan reportedly just sent a tanker called the Karachi through the strait after settling the bill in yuan instead of dollars. This is a direct hit to the petrodollar system that has ruled the world since the 1970s, mate. If the Middle East starts demanding yuan or rupees for oil, the US dollar's status as the global reserve is in big trouble. Central banks around the world are already voting with their wallets by dumping treasuries and stacking physical gold. For the first time in decades, global gold reserves are almost equal to the amount of US Treasury bonds held by foreign governments. China has been on a 16-month buying streak, adding hundreds of tons of gold to their vaults to protect themselves. This isn't just a trend, it is a structural shift that creates a massive floor under the gold price regardless of daily moves. When the world stops trusting paper money, they always come back to the yellow metal, and we are seeing that play out now. So why did gold hit a 4-week low of $4,960 on Wednesday, March 18th? It feels weird seeing gold drop when a war is raging, but it actually makes sense when you look at the paper market. Big institutional traders are facing margin calls in other sectors, so they sell their gold because it is highly liquid. They need the cash fast, so they flush their paper gold positions, even though the physical demand is through the roof. The US dollar index, the DXY, also pushed back toward the 100 mark, which acts like a lead weight on gold. But here is the kicker, Legends. While the paper price is dropping, the premiums for physical coins and bars are staying high. The big banks like JP Morgan are still keeping their price targets for the end of the year at $6,300. They see this current sell-off as a healthy correction that shakes out the weak hands before the next leg up to new highs. Remember, every major bull run has these scary pullbacks that make you want to hide under the covers. Don't sweat the dip, just more room in the pouch, because the fundamentals for owning gold haven't changed one bit. Over on Reddit and WallStreetBets, the sentiment is a wild mix of memes about drones and people calling for a gold moon. Traders are obsessed with Operation Epic Fury and the new LUCAS Kamikaze drones the US is using in the conflict. Some are complaining that gold isn't soaring yet, while the veterans are telling everyone to buy the dip at $5,000. There is a lot of talk about the economic shock from oil and how the Fed is going to have to keep rates higher for longer. The consensus among the legends on the forums is that the US economy is resilient, but the energy shock is a total wildcard. People are debating whether to weight their portfolios toward Meta or Amazon as the tech giants start to diverge. There is a lot of dark humor about the Strait of Hormuz closure and what it means for the price of petrol and groceries. But the overall vibe is that we are in a new era of volatility where you have to be quick on your feet to make a profit. Many retail traders are looking at the $4,840 level as the ultimate entry point. It is a stock picker's market now, and the crowd is starting to realize that hard assets are the place to be. Let's get into the nitty-gritty of the technical analysis for Thursday, March 19th, 2026. On the daily chart, gold is currently trading below its 50-day simple moving average, which is sitting at $4,978. This is a bearish short-term signal, but we are still way above the 200-day average of $4,047. The Relative Strength Index, or the RSI, on the daily chart is at 40.45, which shows we are in a sell zone. However, on the 4-hour chart, the RSI hit a very oversold reading of 27.32 on Wednesday. Usually, when the RSI gets that low, we are due for a mean reversion bounce as the selling pressure gets exhausted. The Bollinger Bands are narrowing on the 1-hour chart, which suggests a big move is coiling up and ready to snap. We are also watching out for a localized death cross on the daily chart, where the short-term averages cross below the long-term ones. But on the weekly chart, we already had a massive golden cross earlier this year, signaling a long-term markup phase. This means the big trend is still up, even if the daily charts look a bit messy and bearish for the moment. Support levels to watch are $4,840, and then the psychological level of $4,800. If we break below $4,800, the next stop could be the structural support at $4,600. On the upside, we need to reclaim the $5,000 mark and then break past the resistance at $5,140. The MACD indicator is currently negative and below the signal line, confirming that the bears have control for now. But don't let that spook you, because the volume on these dips is actually starting to decline, showing the sellers are getting tired. The 50-day moving average is acting as dynamic resistance now, so we need a strong daily close above it to flip the script. We are also seeing a symmetrical triangle pattern on the daily chart, which usually leads to a massive breakout once it resolves. If the triangle breaks to the upside, the projected target is $5,600 or even higher. High-frequency trading bots are creating a lot of noise on the 15-minute charts, so try not to get caught in their traps. Stick to the higher timeframes like the daily and the weekly to keep your head on straight during this volatility. The current average gold price for March 2026 is sitting at $5,115. Even with this dip, we are still up over 15% since the start of the year, which is a solid result. Watch the 5-day moving average at $4,913 as our first hurdle for a recovery. Technical indicators are leaning toward a strong sell on the daily, but the weekly remains a strong buy for long-term legends. To summarize the main points, the war in Iran is the primary driver of the massive energy shock and oil volatility we are seeing. The RBA rate hike to 4.10% has put a squeeze on the ASX and helped the Aussie dollar hold 0.70. Tech stocks are losing their crown as the Magnificent Seven start to underperform and investors rotate into hard assets. De-dollarization is accelerating as oil trade starts to bypass the greenback, with the Yuan becoming a major player in the Gulf. Gold is caught in a liquidity flush, hitting a 4-week low as paper traders dump positions to cover losses elsewhere. Technically, gold is oversold on the 4-hour chart and is currently testing critical support near $4,840. The long-term bull market remains intact as central banks continue to stack gold at record levels to hedge against global chaos. Now, back to the big question. Do you reckon this is the bottom of the dip, or are we going lower before the next moon mission? Let me know your thoughts in the comments, and don't forget to like and subscribe to stay ahead of the markets. We will be back tomorrow with more updates on Operation Epic Fury and the latest moves on the ASX. Stay active, stay legendary, catch ya.